not closing entries. This is part 15 of 17 videos explaining the essentials of accounting. Let's talk about closing entries.
Closing entries are all about temporary accounts. And temporary accounts are like the trip odometer in your car. Most cars nowadays have two odometers. One you're not supposed to mess with. The other one you punch every now and then to measure the distance of a particular leg of a journey you're interested in measuring. Now the miles on the trip are on both odometers. It's just easier to harvest the information about the trip if you just punch the trip odometer at the beginning of the trip and read the mileage at the end of the trip. That's exactly what temporary accounts are for. Remember, temporary accounts are all about equity, changes in equity. If we put all the information directly into the equity account without the benefit of temporary accounts, it's like having no trip odometer. It's much more difficult for us to sort through the changes in equity to find out what events during the period happened to improve the efficiency of the business. So one of the important features of closing entries is it lets us harvest the information about activities during the period. While we're in the process of harvesting this information, we update equity account for all the changes that did affect equity, but which were placed in temporary accounts during the period. Now we reset the equity account, updating assets equals liabilities plus equity. Keep in mind that if you take the combination of transactions analysis and overlay that with adjusting entries at the end of the period, we have a pretty good measure of assets and liabilities. What we haven't got is a solid ending balance for equity. Closing entries gives us that solid balance. The third thing that closing entries does for us is it resets the temporary accounts to zero so that we're ready for our next trip. But the last feature about closing entries is they are unbelievably easy. You have just come through three big equations: transactions analysis, debits on the left, credits on the right, aid and lure, adjusting entries, the 6 cells. Oh my. After working so hard on all these ideas, I couldn't grasp that there really was no trick to closing entries. They are unbelievably easy. There are only 4 entries, and we're going to walk through them now. We're going to go back to Mo Futz's T accounts, the ones we used for transactions analysis a couple of chapters ago. The first closing entry closes all temporary credit balances. We mean revenues. Here we see that sales, second row, right T account, has a balance of $4,000. We want to reset this temporary account for the next trip. Now, what do you think we have to do to the sales account that's got a credit balance of $4,000 so that it's reset to zero for the next period? And the answer is, well, debit sales $4,000, credit something. And that's exactly what the closing entry does. Debit sales, and here's a brand new account, income summary. This income summary account is a super temporary account. It exists only for 3 entries each period. It exists so that in our actual ledger cards, we have the number for net income for a period. It's collected here in income summary. That's the first closing entry. Let's look at it in the T accounts. And there you see sales has been reset to zero. It's ready to go on the next trip. Meanwhile, the credit balance of $4,000 that used to be in sales is now sitting in income summary down below. We woke up income summary. It's been asleep for the entire period. We just woke it up with an entry by moving the credit balance of sales into income summary. The next closing entry closes the 3 gray ledger accounts, the expenses on the bottom row: cost of goods sold, rent expense, utilities expense. How do you think we're going to reset these to zero? Credit cost of goods sold, $2,200. Credit rent expense, $600. Credit utilities expense, $100. And that's exactly what the entry is. This time, we debit income summary to move the debits that were in expense accounts into income summary. Meanwhile, each of the expenses has been separately identified, resetting each one individually to a new zero balance. When we look at the ledger accounts, sure enough, all 3 expenses have been reset to zero. The aggregate of these 3 accounts, $2,900, has been moved as a debit to income summary. And for the first time, we know net income for the period is $1,100. We can see it as the net balance in income summary. It is now time to put income summary back to sleep, we want to close income summary. Obviously, to reset income summary to 0 and put it to sleep, we need to debit 1,100 to income summary. Let's take a look at that entry. And there we see income summary has now been set to 0. It is put to sleep. Meanwhile, capital account has increased $1,100. There's one closing entry left. You see MF drawing? That's a temporary account for withdrawals by owners during the period. That needs to be reset to 0 for the next period as well. The entry will be credit MF drawing, debit MF capital. This is a reduction in equity because the owner is disinvesting from the business. That's why this closing entry always debits the capital account. And there we have it. MF drawing is now reset to 0. It's ready for its next trip. Meanwhile, MF capital has been updated completely. The ending balance is $12,100. We have reset assets equals liabilities plus equity. The temporary accounts have been emptied. They're ready to take on the values generated in the next period. And we can check that assets equals liabilities plus equity without the temporary accounts for the first time. 12,200 in assets equals liabilities of 100 plus equity of 12,100. That is all there is to closing entries.
Well, I've told you all there is to know about closing entries. Now that we've talked about the three big equations in accounting, transaction analysis, wrapping up the period, let's step back and take a look at the big picture of financial reporting. That's our next part.